If you just go the way everybody's telling you to, which is you stick your money in an index fund or a mutual fund from your 401k, I hate to tell you this, but your money isn't going to grow as quickly as it should. It's not going to grow perhaps even as quickly as people think it will. See, just to put this in perspective, if you listen to the people who are out there talking about the stock market, you'll think that the stock market is just going gangbusters, right? 20-some% last year on the S&P 500. Well, it's not. This is just a bunch of hype. If you put your money in the market in January of 2018, just a little over 2 years ago, you would have about a 3% return. 3% return. So guess what? The stock market is fully capable of growing at 5%, 3%, 0% for the next 20 years. And if you just put your money into the market in general, you're in trouble when it comes to financial retirement. And if you want to put your retirement nest egg into a savings account, good luck seeing any kind of return at all in today's low interest environment.
And I was getting such insane returns that I started having ideas of maybe starting to start a margin account and starting to invest money that wasn't even mine, just for the mere fact that the stock market was going up so fast and there was so much money to be made and there was so much money I was making that it started to give me a false interpretation of how the stock market worked. And I started to get like the fear of missing out. And I'm like, man, there was this stock I just bought recently. It's already shot up 20%. I wish I had bought heavier. I wish I had even margined out money in this stock so the gains could have been 2x from what I got. What if instead of putting $50,000 in that stock, I put $100,000 in that stock? That stock just shot up 20% like nothing. I just missed out on thousands more dollars of gains or tens of thousands. What am I thinking? And this is the way you start to think when you see that type of performance, okay? And so I start margining out, and going into 2015, guess what happens? All that types of unbelievable performance ends.
So why make decisions? So many of you are going to run into money for the first time this year, and you're going to make $130,000 instead of $60,000 for the first time, and what you're going to do is go buy stuff. I've put in so much work. Don't I deserve now to cash in? The answer is sure. You can cash in anytime you want. The problem is when you cash in, you cash in. And what do I mean by that? I mean that the second you cash in, you're taking money out of the kitty that can be in investing, and you're converting it into something short term, which is your prerogative. Like, do you? But one of the missions I have here is to teach people how to build big things, honey empire, and the way you build big things is continue to invest in those things.
Most people think that the stock market is a game of numbers, but it's mostly a psychological game. How do you make money in the stock market? You study and analyze companies and find out undervalued stocks, because eventually they will rise up to their real value and you make money. However, the problem is most people buy high and sell low, because most people invest based on the headlines that they see in the news, but it's too late already. The first rule of investing is, if everyone is investing, it's a bad investment. The price is just increasing. It seems like a good investment. First, you hesitate. There is still a shred of doubt in you. But the price is rising right in front of your eyes. So you convince yourself that you have to take the risk if you want to make money. Aren't you the great investor? Hence, you invest. The stock price keeps rising, so you feel happy about your decision. But after a while, the price slightly drops. You don't pull out because you haven't lost anything. The price just dropped to the point where you invested. So, not a big deal. But it plummets further. You get a bit nervous, but you know that as an intelligent investor, you have to be patient. Unfortunately, in the next few days or weeks, the price just keeps plummeting. At some point, you just get frustrated. You pull out before you lose even more money. Isn't that what happened with Bitcoin, for example? The stock market is much harsher than you think. You are competing against people like Warren Buffett, George Soros, who have hundreds, if not thousands of people helping them, from accountants to specialists. They spend endless numbers of hours figuring out how to take the hell out of you. I'm not trying to discourage you from investing. I just want you to know that you either get really serious about the stock market, or for God's sake, Don't waste your money.
Without the right discipline, the right framework, the right, dare I say, philosophy, well, you're going to get yourself into trouble. But I also know that big picture financial advice can be hard to process. A lot of it seems downright contradictory to most people. We tell you to have conviction, for instance, to stick with the companies you believe in. Then we say you need to be ready to change your mind on a dime when the facts change. You need to be cautious because it's so dangerous out there. But you also need to be ready to pounce on opportunities when they present themselves. Try to put all this discipline stuff into perspective. If you pick your own stocks, the thing you really need above everything else is good judgment. But obviously, good investing judgment is not the kind of thing anyone can teach you in an hour of television or even a year of television, for that matter. That's why I try to help you build good habits. I try to teach you better ways to think about individual stocks and the whole market. I try to give you the tools you need to develop your own judgment. All my best professors in college focused on teaching us how to think, not teaching us what to think. I've always tried to take my cue from them. I want to teach you how to be a better investor, not just tell you the stocks that I think are good investments. The problem is, that's a heck of a lot to process. So let's try to put it all in context. First and foremost, when you're managing your own money, before any other consideration, you need to know yourself. I've said this before, I'll keep saying it because it's so important. You simply can't know which stocks you should buy if you haven't taken the time to really consider what your own personal objectives are, and I can't decide them for you. Do you need to build up your wealth to ultimately make a major life-changing purchase like a home? Are you just trying to get a decent return as you save for retirement? Do you have money to burn that you're willing to take risk on more speculative propositions? Those are all different mindsets. So the truth is, there is no one-size-fits-all approach to investing, and anybody who tells you differently is either dangerously misinformed or flat out lying to you.
The real test of whether you're investing from a value standpoint or not is whether you care whether the stock market is open tomorrow. If you're making a good investment in a security, it shouldn't bother you if they close down the stock market for 5 years. All the ticker tells me is the price. And I can look at the price occasionally to see whether the price is outlandishly cheap or outlandishly high. But prices don't tell me anything about a business. Business figures themselves tell me something about a business, but the price of a stock doesn't tell me anything about a business. I would rather value a stock or a business first and not even know the price, so that I'm not influenced by the price in establishing my valuation, and then look at the price later to see whether it's way out of line with what my value is. You get overstimulated in Wall Street, and you hear lots of things, and you may shorten your focus, and a short focus is not conducive to long profits. And here I can just focus on what businesses are worth, and I don't need to be in Washington to figure out what the Washington Post newspaper is worth, and I don't need to be in New York to figure out what some other company is worth. It's an intellectual process, and the less static there is in that intellectual process, really the better off you are. In the securities business, you literally every day have thousands of the major American corporations offered to you at a price that changes daily. And you don't have to make any decisions. You have to make, nothing is forced upon you. So there are no called strikes in the business. The pitcher just stands there and throws balls at you. And if you're playing real baseball and it's between the knees and the shoulders, you either swing or you get a strike call on you. If you get too many called on you, you're out. In the securities business, you sit there and they throw U.S. Steel at 25 and they throw General Motors at 68, and you don't have to swing at any of them. They may be wonderful pitches to swing at, but if you don't know enough, you don't have to swing. And you can sit there and watch thousands of pitches, and finally you get one right there where you want it, something that you understand, and then you swing. And
so you might not swing for 6 months.
You might not swing for 2 years.
Isn't that boring?
It would bore most people, and certainly boredom is a problem with most professional money managers. If they try to sit out an inning or two, not only do they get somewhat antsy, but their clients start yelling, "Swing, you bum!"
So I have certain stocks I'll share. Overall, I'm up, but I have a lot of stocks that I'm down, that I've lost money thus far. But that's okay, because when you have that long-term approach and you've done the research behind what you're buying, you're not that affected when it's down. Because when it's down, you just look at that as a buying opportunity to buy those stocks at a discounted price, because you're in it for the long term. And you know that long term, those stocks are going to correct, and you're going to end up getting a great capital gain and appreciation. But Again, all that only matters is if you sell. What I'm primarily after but most of my approach is after the dividends, the income that my stocks provide for me. And I'll share with you guys a little bit more about that, what that is. Because regardless of whether the stocks are up and down, I still get the dividends. The dividends is the income that they're paying out to me either every month or every quarter or every year based on the stock. So that's how I look at it. I also look at it as, because I'm a long-term investor, when there's a correction every year, that's a great buying opportunity. Recently, we had a bit of a correction in the market. Great opportunity to buy more at a discount. If there is a recession, which typically throughout history has happened every 10 years or so, I think we're due for one pretty soon. If there is one, it sucks for a lot of people out that lose their jobs and things like that. But when you have time on your side and you're a long-term investor, that's a great opportunity to buy more at a discount.